We have Nikhil Niganla, who is a director at Bernstein, joining us on the show right now. Nikhil, thank you so much for being part of the show. And I just want to take a statement from your report that you've written, and you've spoken about the fact that the best is behind when you talk about the wind equipment or thermal equipment story, as well as transmission capex estimate revisions. If you could help us understand more about it, what's the story behind, what's exactly the demand picture right now?
Sure. Happy to share my view. So see, the power sector, what is most critical is power demand. And then I'll come to the specific theme. So power demand, what has happened is softened a bit. So last 3 years, the power demand CAGR was almost 8 to 9% per annum. And now it's fallen to low single digits in the last 6 months. So that's been the key reason why the sector has softened up a bit. The second big event that has happened in the sector is battery prices. So battery prices have fallen a lot. No one envisaged battery prices to fall at the rate at which they have fallen. Hence, the business case for grid scale battery storage is much better now than what it was a year back or so. So what these two things mean is, one, if you look at wind specifically, so wind is helpful in the evening hours of the day. That's a key reason why wind saw an uptick in the last 2-3 years in terms of capacity addition, or at least in terms of orders to these equipment suppliers. But now with battery becoming so cheap and the challenges in setting up wind plants, the need for incremental wind softens. Incremental wind capacity sort of comes down a bit. So that is why we think, wind, we are not very positive as a space going forward, which is this battery impact and the challenges with land. The second point you made is on transmission capex. So see, transmission, we are not negative as a theme. We still think transmission is a long-term theme, and that capex numbers which Power Grid has guided on, they should be able to meet. But what we meant is the capex upward revisions, which is what the sector people were playing at for the last year or two, that is more or less done. So Power Grid guiding 35-40,000 crores a year capex, that's more or less now understood by the market. We don't expect further upward revisions to happen on that. So that's what we meant by those statements. And thermal also, I mean, while we are again positive on the thermal theme, the challenge is batteries again. Because batteries have become so cheap, they can be a good source of power in the evening hours, which puts into question whether beyond the 80 gigawatts of thermal India has planned, will we be adding further capacity after that.
The headlines
So, yeah.
6-8 months ago were that Indian power demand is surging. There is more demand and there could be a shortage. Prices were going unchecked. Suddenly, and if I use your report for reference and other media reports, there is a big slowdown in the new power plant additions and the signing of new PPAs. So what's going on from a situation of desperate addition to no addition? What is happening?
No, good question. See, the biggest driver, as I said again, is power demand. So power demand slowing from 8% to low single digits. That's a key reason why Discoms have become a bit more reluctant to sign PPAs. We have seen this before as well. So, and the other reason is we did a lot of renewable tendering in the last couple of years, which the system could not absorb. So combined with low power demand, that is why PPAs are not getting signed. We have seen this in the past. 2019-20 also a similar thing happened. We did a lot of tendering. But when demand picked up in 22, all those PPAs got signed. So this is something I would say a bit cyclical. It should be reversed with time, as our fundamental belief is still that 1x of real GDP should be a base case assumption for power demand. 6 months here, 6 months there, but a medium-term outlook is still the same in terms of power demand. And as to power shortage, even if you look at the spot power prices today, it's still 10 rupees in the evening hours of the day, in the morning hours. So essentially, the non-solar are a problem that is still there in India. It's not gone so much. Renewable is where you've seen a slowdown in PPA signing as demand has softened and a large quantum got tendered.
But logically, some would say that renewable demand or renewable PPA should only go higher because that's where the government push seems to be, that's where the government drive seems to be, and also the way renewable prices are coming down now from about 9 rupees a unit to about 3 rupees a unit. Isn't that a no-go?
So what is happening on the renewable, we have to realize it's not as if, I mean, PPA slowdown has happened, but it's not like construction has slowed down. So we are still adding 30 gigawatts of renewable a year, which is a huge number. So 30 gigawatts of renewable is a capex of almost 2 lakh crores a year. So while it's not as much as we expected, but it's still very much ongoing. Plus the other sort of softening aspect has been rooftop solar. With a strong push coming for rooftop solar by the government, the need for afternoon power demand sort of reduces a bit as rooftop solar itself starts generating. And there they are seen a strong push from the government. So that's the factor. But yeah, to your point, it's lower than what we expected, but it's still 30 gigawatts of renewable a year, which is possibly the third highest quantum of renewable addition in the whole world after China and US.
So, Nikhil, how does it really draw down to an investor? Would you say that the heydays and the renewable returns are a mirage, like you rightly questioned in your report as well?
Yeah, so from an investor standpoint, renewables, see, as a space, we find a bit expensive. Most of the stocks which are there. Renewable as business returns are usually early teens at best. It's not a very complex business. So hence, we have always preferred playing the sector by an NTPC, for example, which has a mix of both thermal and renewable to play. And on the thermal side, they have almost guaranteed returns in the cost plus business model. And even in terms of valuation, they are much cheaper than some of the private sector peers that we see. Again, while they've corrected from the top, but that's the name we choose as a top pick to play the mix of thermal plus renewable.
Right. Nikhil, I wanted to talk about Discom indicators that you've indicated in your report, where you said the AT&C losses are rising now. It's risen to about 18% in FY24. The power tariff hikes were minimal. There is also a growing clamor around how you want a free electricity or the noise for free power. Do you think that this would pressurize the Discoms further? Do you think that we are staring, or we will likely stare at some full-blown crisis in Discoms that we had seen earlier on as well?
Yeah, so let me just clear that point, and also, to add to an earlier point, see the biggest difference between, let's say, a 2010-11 to 2024-25 right now is the fact that last time we had a lot of power plants being built in India without any PPAs getting signed or offtake agreements getting signed. And banks were lending freely. They were falling one on top of the other to lend to these power plants, which took 5 years to build. This time, while we have seen demand softening, but the good thing is all the capacity which is under construction in India is with PPAs, is with guaranteed offtake agreements. So that is a fundamental reason why we think the last cycle is different from what we have in this power cycle in India. And we are not too bothered by the near-term power demand slowdown. Now, coming to Discom Health, Discom Health deteriorating, yes, that was something that came as a surprise. We didn't expect AT&C losses to go up, which is what has happened in FY24. But there again, Discom's health improvement is a very long drawn process. It's a politically sensitive area, given power tariffs and, loss reduction is involved, power theft reduction is involved. But the government intent is very much there. Especially the central government, the push from their side to force Discoms to cut losses and improve their profitability, that's visible in any policy action they take. And even steps like, Uttar Pradesh now looking to privatize a few Discoms, we think it's a step in the right direction, helping improve Discom health. So, to your question, yes, there are some near-term scuttles here and there, but our medium-term view on the sector, positive view on the sector is still intact.
Start breaking it down, and I'm just doing it for the benefit of our viewers. There is thermal and there is renewable. Then there is transmission. Then there is distribution, and then there is power financing. This is the entire chain in which the entire power sector moves. Between renewable and non-renewable, which is coal versus solar and wind, you feel one is better off betting on the traditional power companies like NTPCs and Tata Powers of the world, because they are focused on fixed price where they will get assured returns irrespective of the power prices. Is part one correct?
So just to clarify, so NTPC, yes, for the reason. So it's not fixed price, it's fixed sort of return. So their returns are guaranteed, 16%, sort of 15.5%, 16% ROEs they make. And it's a good hedge between thermal and renewable. So yeah, so that part you're right. Yeah.
Second, when power is generated, there are equipment which is required to generate power, which is where, let's say, the ABBs and the Siemens and the Gs of the world come in. So who will benefit? Will the traditional companies which build power for thermal, they would benefit, or companies which essentially are building capacity for solar, let's say a Vari or a Premier, which is a better idea?
So actually the third, I think, which we haven't discussed, is the transmission capex plays. I think that's where we see higher barriers to entry, while we don't cover the names, but as a theme, transmission capex is something we are confident on. at least on the domestic market, that's very much intact. It's not going to go away. So that's the part where I would say on the thermal side, there are not too many players. They're just one. And on renewable solar equipment manufacturers, while we think near-term earnings are good, we are concerned on oversupply and low barriers to entry. So transmission equipment is where, as a theme, we think we are the most positive on the equipment side.
Making it just very simply for our viewers. You generate power, you use equipment, then you transmit power. When you transmit power, you need wires, you need poles, you need meters. Is that a good play? Because it doesn't matter whether it is thermal or whether it is solar. Power will be transmitted, which means the demand of transmission and transmission equipments and poles and grids, that will continue.
Absolutely. And just to add, I mean, even within the transmission part, one is the wires and the poles. The more important one is the substation, where the transformers are put to step up, step down power. That is the key area where the returns for equipments could be better. And it's not just in India specific, it's actually a global theme where transmission is a massive constraint for any country in the world you take, whether it's the US, in Europe. So transmission equipment manufacturers are benefiting not just in the surge in capex in India in transmission, but also globally. And to add to your point, transmission need also increases because all these renewable plants are coming in very remote locations in the border areas of Gujarat, Rajasthan. So you need to evacuate power to the rest of the country. And as you rightly said, thermal or renewable, you need transmission. So it's a much safer, relatively safer capex story to play at.
Nikhil, always good having you on the show. Thanks as always for your thoughts.
Thank you so much.